current projects that have some headwinds from interest rates are still executing on their value add plan, which as we look at deals, that's the key.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today is going to be a little different. This is more of a recap episode of my recent trip to Dallas. However, I'm going to talk about both some current investments that we are in that I was able to tour, as well as the Marina RV Park investment, which we made in Fund 2 that's going really well. And I met with that operating team, and they're working on some new acquisitions in the coming weeks. And also met and spent some time with our oil and gas partner. That's an investment I have personally, and I've had Bruce on the podcast before. So if you have interest in oil and gas, the major benefit there is it can offset active or W-2 income. So we are getting up towards the end of the year, and if you're doing tax planning, it can be a interesting way to offset some current tax burden for the year 2023. So the main reason for this trip was there was an investor event for the Marina RV Park investment, and I already did a fair amount of diligence because Fund 2 made an investment into a fund called Windless Marinas, and we got in at a unique time. The group had already bought 2 marina RV parks, and they were just finishing out the final few $100,000 of the raise. So they'd already closed on the assets, they'd already been operating them, but they had a little room left in their fund to finish raising some capital for capital expenditures and improvements. So we had the benefit of coming in at the very end. And as someone who's focused more heavily on multifamily in the last few years, really intrigued with the Marina RV Park business plan. The cap rates can be 12% or more, and there's generally a immediate current cash flow. And I know from talking to our investors, there's certainly a demand for current cash flow, which is was much more difficult to find on a heavy value add over the last few years. With current market conditions, I think there's been a new focus on cash flow, on multi. But to get a 12 cap is really not heard of in the standard multifamily or really any of the traditional syndicated asset classes, whether it's storage, mobile homes, etc. So really unique. It's a mom and pop business model. It's a roll-up model. So most of the sellers have owned these marinas 20, 30, 40 years. And, they're at the moment too small for a larger private equity fund. There are a few large private equity funds that do invest in marinas, but this market is perfect to do a roll-up where they're aggregating and buying a bunch of smaller marinas. And if they can put together 10, 15, 20 marinas over the next 5 years or so and execute on their plan, the exit strategy is going to be significantly to sell at a significantly lower cap rate to a larger PE fund who is just not going to go after the smaller acquisitions that our partners are going after. One of the examples I heard while I was there last week is that one of the prior owners, instead of having an advanced accounting software to track all of their docs, they literally had Post-it notes on a map essentially that showed who owned which dock, and there was little check marks on did they pay their rent that month. So ultimately, I think there was some type of accounting software, but they were not tracking the docks through more sophisticated property management, rent collection software. So these are the inefficiencies in the market, and it's I think a great asset class that we're excited about, and we're going to continue to invest in both through Fund 2, and we will likely have some individual opportunities as well. So we'll be continuing to put content out, and I actually recorded a live podcast with Matt Layton and Josh Conley from New Haven Marinas. So we will have that episode out in a few weeks, and we'll likely do some additional highlighting with them. Next, I was able to take a tour and get an update on one of our investments, the Tides Lakeview in Garland, Texas. Garland's about 30 minutes east of Dallas, and this was an asset purchased in 2021. So it was purchased with a bridge loan when rates were still very close to zero, and it had a heavy value add business plan. So there's been some challenges with interest rate increases with this asset. I know a lot of people are concerned. There's a fair amount of headlines about bridge loans. There's a couple high profile issues in Houston. Nothing that we were involved in, but the bridge loans have made the news, and fortunately, this asset, at least execution-wise, appears to be going pretty well. There's 44 units that have been renovated over the past 2 years, and average rent increase from prior rent is $324. So that's a 35% increase above prior rents, and we're actually 6.7% higher than the underwritten rents. Classic units that have not been renovated have had a 10% increase over previous rents. So, overall, we're consistently increasing rents whether a unit is renovated or not. With that said, the initial earlier stage, the vacancy rate ticked up because of higher renovations, and moving forward, there's a push for occupancy to make sure we keep that occupancy in the low 90s. While I was on site last week, the physical occupancy was, I believe, 84%, but they are pre-leased just above 90%, and that 90% is a key metric. So we want to keep occupancy high, and with the bridge loans and the potential expiration of interest rate caps or needing to purchase new interest rate caps in year 3, it's important to keep occupancy high and to just grow net operating income as much as possible, so that when we go to refinance or potentially sell, we've increased that net operating income significantly. And although cap rates have expanded in Texas and especially in Dallas, not as significantly as interest rates have moved. The cap rates are much more tied to the 5 and the 10 year, and those have ticked up in recent weeks as well. But the other good thing about this asset is, although we've renovated 44 units, there's still a significant amount of units to continue to renovate, and we've demonstrated that the rent growth can be significant on a renovated unit. So that actually helps keep the cap rate somewhat compressed, because the new owner does factor in the ability to continue to value add and raise rents. Lastly, I was able to catch up with our oil and gas operator. Met up with Bruce and hung out at their office a bit and got an update on oil and gas. And they have a unique model. We've talked with a number of oil and gas operators, and what I like about Bruce and the DW model is they're not actually the ones drilling themselves. What they're doing is tracking the larger firms that are drilling, and they're able to actually buy up or lease the mineral rights in the vicinity where the other big operators are drilling, and that allows them to participate. So I love that business model. it takes a lot of the operational risk out of things, and it in many ways mirrors what JCAM Investments does on our investments. Meaning we actually partner and piggyback off of the operations of very experienced, well-capitalized firms, and that takes a lot of our risk out of play by not having to deal with the operational execution and the overhead and everything that comes with it ourselves, and plugging in with high-quality partners that have that experience, the infrastructure in place, and the deal flow, which is extremely important. There's thousands of permits filed for potential drilling, and ultimately, there's a lot less of them that are drilled by institutional quality billion-dollar company operators that have the money to do all of the due diligence to make it almost certain that oil is going to be found, as opposed to a smaller operator who's just drilling a small well somewhere and hoping to find oil. That's what we certainly want to avoid. So overall, my takeaways are that now is still a great time to invest, even with interest rates higher. There's great opportunities. Our current projects that have some headwinds from interest rates are still executing on their value add plan, which as we look at deals, that's the key. I've said over and over again, if you can execute on the value add, if you're raising rents through renovation and forcing appreciation, that business model works in any market. We are also seeing some interesting new opportunities. The latest offering that we put out, the Creekside opportunity, that's actually being bought from a REIT. And it's a private REIT that has the ability to do redemptions, and because of redemptions, they chose to sell this asset, and they are actually selling it at a discount to where it was purchased a few years ago. So we are seeing some great new opportunities. They're in some ways distressed. This was actually distressed because of the liquidity needs of the fund, not because of a problem with the property, but they were somewhat pressured into having to sell this one at not the most opportune time, and that's a benefit for us and our investors. And there's a new opportunity that's going to be coming out late this month, early September, and that one is more of a distressed opportunity. That's actually coming from a syndicate that has a bridge loan that is facing pressure to sell, because otherwise they'd have to raise additional capital to cover the interest rate increase for the coming years. So that's going to be a unit we're buying at a significant discount off of where it sold last time, and I don't know exactly what the limited partner returns will be from that deal. That we were not involved in the previous deal. It's not someone that we had worked with, but some of those investors are probably going to be lucky to break even, because it is going to be sold at a discount to its prior purchase price. So their loss is our opportunity, and for those investors who have been on the sidelines or were worried that real estate was overpriced, we are seeing some really good entry points at this stage, and we're entering with good loan to value, debt that's fixed for the duration of the project plan, whether it's 3 years or 5 years, basically prepaying and locking in interest rate caps to get a fixed rate for the term of our business plan, and it's a great overall opportunity. So lots of good things happening, and still a lot of noise there in the economy. I don't know what's exactly when interest rates move, but if a deal pencils out today with these rates, there's a lot of built-in upside if rates do decline, and frankly, if rates remain high for a longer period of time, it likely means inflation is going to continue to remain high. And I'm a firm believer that even the inflation statistics that are published are likely understated. There's a website called Shadow Stats that shows how they used to calculate inflation, and if you look at Shadow Stats, inflation, the old way they calculated it would be significantly higher. So I think some of this is just trying to skew the numbers for good press. What we see across the board is inflation's continuing, rents are increasing, even in areas where the headlines say rents have stalled. We're seeing in the workforce housing, the Class B apartments that you can't build for the cost of purchase at this point. Those rents have been stable or and increasing, both on the classic unit renovations and especially on the newly renovated value add units. We're still seeing significant rent growth both through forced appreciation and surpassing the pro forma rents in nearly all cases across 40 plus properties we're invested in across our series of funds. So hope some of this recap was helpful. This is active passive investing. We're on the road. I'm traveling to conferences. I'm looking at opportunities. I'm talking with sponsors, and then updating our investors on what we've uncovered. So hope this is helpful. We'll keep these coming. Have a bunch of videos and other content from my trip last week. So we'll be putting that out in the coming days or weeks. Check out our new Facebook group. We've got a Facebook group for Alternative Investor Mastermind, so please connect with us on Facebook. And we're also on YouTube, Instagram, LinkedIn, and pretty much all of the social media platforms, even Twitter X, we have an account. So please stay in touch with us. Reach out if you have questions or topics you want to discuss, and we'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.